I just try to know who I'm talking to. First of all, Don, this is the first time I've heard a speech where I haven't disagreed with anything. My partner in the back, Barry Schindler, is the head of our Don't worry. He will definitely interrupt me if he feels the need, if he's paying attention. Barry is the head of our patent prosecution group. He works with about 100 companies here. He's a genius in patents. I would never trust him on politics. But he has actually been able to get patents for some companies that have been working 3 or 4 years, came in, changed strategy, and got about 3 or 4 of them in the last year, in 3 or 4 months after a change in strategy. So I talk to him about every company I have. Let me tell you a little bit about me very quickly and the firm. We're a firm that started in Miami, Florida, of all places, with 3 Jewish guys who couldn't get a job anywhere else. So they decided to start this firm, make it New York style, entrepreneurial, try to help companies do things besides just being their lawyer. And I joined in the 80s. I thank you for letting everybody know how old I am. And when I joined, it was 80 lawyers, still one city. None of us ever expected to have happen what happened today. We're 36 offices, including one in Tel Aviv that only does U.S. law, and 1,700 lawyers and 50,000 clients in any one year. The majority of our client base is entrepreneurial, middle market, and smaller. We do a lot of small deals. We do big deals. About second Intifada, 12 years ago, my partner and I saw that nobody was coming to Israel. And we decided we would do what our firm did best, which was one of the things we did best, which was match up companies strategically, come to Israel, called it Ksat Zioni, Ksat Kalkali, and we made some matches and started meeting people, and 3 weeks a year has now become 3 months a year that I spend here. Barry has been coming for the last 5 years. He spends almost as much time here as I do. And we've worked on a number of deals, and we represent a lot of companies. The largest being, I represented IVAX when it merged with Teva. I represent Teva. I don't know if you're familiar with Prolor or Biologics. Those are 2 deals that I worked on. I just recently did a public offering for Galmed, and I did a private deal for Immune Pharma, and I can keep going. But that's not what you're here for. So the purpose of this talk is to discuss, I guess, growth in the transactions in the Israeli life sciences and agro. Still the same topic? So it didn't change, okay. So as I said, I've been coming here now for 12 years, basically. And when we first came, it was very hard to get a deal done, any kind of deal. The market was really bad, things were bad. I have never seen in the last 12 years a better time to do a deal than today. And then although the last week has been a little down, but this time period right now has clearly been by far the best time to do a deal, and it doesn't necessarily even matter what size company you are. In fact, I think that in some cases the smaller companies are finding it easier than some of the larger companies to get a deal done. And there are all sorts of ways that the deals are getting done. When you look at the Israeli market, there's a guy who, one of the things I've been doing in the U.S., won't be in the same order as the last talk, but one of the things I've been doing in the U.S. is working with what they call Jewish federations and foundations to try and get them to invest in Israel. Believe it or not, those organizations invest more in oil companies and other things than they do in Israeli companies, and partly for fiduciary reasons. So there's a guy named Steve Schoenfeld who set up a fund, an index fund called the Blue Star Index Fund, which shows that in the last 10 years, if you had invested in an Israeli company, whatever exchange it's on, or a company with connections to Israel, that you would have done better than you invested almost anywhere else. Pardon? I see Adon shaking his head. And he has an index fund that some of the federations and foundations have invested in. Our hope is to convince more and more of them to do that and to get beyond the index fund to VC funds. Companies are harder because of the fiduciary rules, but the point being that you could really have done well here. So if you look at the Israeli market, 2000 and the general biotech agro market, 2000 was the year that most of the deals, the most popular year in terms of number of deals. In 2013 was, no year since 2000 until 2013 came close. 2013 didn't quite get there because it didn't really start in the beginning of the year, but 2013 in terms of deal size was about half of 2000, which is the first time we even got near that. This year is ahead of the 2013 pace. We'll see what happens. You never know what's, in this world, what's going to happen. If I could predict it, I wouldn't be talking to you guys right now. But if I could predict it, it would be great. But I believe, for various reasons, that unless something really traumatic happens, that this is going to last for a little while. So I will go out on a limb with that. Again, I'm only a lawyer. What do I know? But from what I see and all the signs and indications, I think it's going to last for a little while. Why? Again, I don't know for sure. But one of the things that I think is playing a big role is where else you can put your money. So you can't retire off interest on a bank account. It just doesn't work. You can invest in real estate, but it's not that liquid. So, and in some places it's doing better than others. So I think that what you're seeing is a lot of people investing in the stock market and putting their money into funds that are investing in the stock market. And eventually, after some period of time, companies have money. You've got to do something with it. You can't just sit on it. And I think that's a large part of what's happening. When you look about here in Israel, it's not just Israel where it's happening, but I can tell you I usually do 8 to 10 meetings a day. And yeah, I meet some people more than once, obviously, but every time I see a new technology, this place is just amazing. It's like, from artificial pancreases to chips that let you see if you're blind to, I can go on and on. It's just amazing the technology that goes on here. And more people are becoming aware of it. More and more people are coming here. I can tell you from the U.S., because we're here so much, I'm getting more and more inquiries about what kind of technology can I find in Israel. I don't see it slowing down right now. Whether it turns into business for somebody or investments, right now it is, but we'll see what happens. But right now, it's going pretty strong. Not only that, I think when I started coming here, yeah, there were people that were looking at China and not necessarily the U.S., but the amount of people and the amount of work happening and the amount of investment coming from the Far East has significantly increased. I was just on a agri tour. We sponsored the AgriVest conference, and we're sponsoring, by the way, if you please show up, the Israel Innovation Conference, which is the high tech and the biomed. But we sponsored the Agritech conference, and I went around with them for 2 days. 2/3 of the bus was Chinese, Chinese business people looking for agro investments in Israel. So, I mean, it's all good. It's all good. Now, if we can only convince them that Israel is not a 6 billion population, larger than, because some people actually believe that, but, and the most powerful country in the world. So there are a lot of things happening that that are, I think influencing what's going on. In the biotech space, there are probably 6 or 7 drugs that originated from Israel that are out there right now. Because of the generics and Teva and a few others, close to 20% of the prescriptions in the U.S. are from drugs that are made by an Israeli company. So it's pretty interesting when you look at it. The other thing that's sort of interesting when you compare 2000 to today, this year and last year. 2000, even though you had all that market share, all those deals getting done, they lost money. They didn't have great aftermarket performance. Last year, the biotech deals, I'm not counting the medical device, up 26%. This year so far, I'm sorry, up 36%. This year so far, almost 50%. So it's not every deal, but on average, the deals in the life science space are up that high. And by the way, please ask me questions. Or, thank you.
Can you say something about the companies that are looking for these kind of deals? Are they big companies? Are they small? Are they private? I'm coming from Abbott, for example, and I know that they are...
Coming from where, I'm sorry?
Abbott.
Okay.
Abbott Lab.
Okay.
And I know that they are looking for, not for small companies and not for seed money, they are looking for mature companies. It's totally different than the one that they were looking for in the last 3 to 4 years.
Okay, we can talk about that. First of all, we did Starlim's deal.
You did?
I did. Well, we did the offering, and secondly, we won the major litigation for Starlim's in the U.S. Thank you. So, there's been a lot of talk back and forth, and I will make full disclosure. I do work for Teva, which I said before, and I represent Phil Frost, who's the chairman of Teva. So, but there's been a lot of talk back and forth on what Teva is doing in Israel, and now they seem to be more interested. I happen to know, at least from the chairman's perspective, that there was never any intention, at least there, to stop doing deals in Israel. That wasn't the issue. The issues were other things. But I believe that most, and in fact I know, that a large number of larger companies have come to the conclusion, and I'm not saying this is Teva, by the way, have come to the conclusion that they can't innovate very well anymore. Now, most of those companies are looking for devices that are closer to commercialization or later stage pharma or biotech. They're not generally looking to in-license something that's preclinical, although that can happen in the right situation or phase 1. And rightfully so. I personally love to do a deal with a smaller or middle market company that's entrepreneurial, much more than I would like to do a deal with a large company where I have to wait for 20 people to make up their mind. So, and that happens a lot in some of the larger companies, not all of them. Sometimes you get somebody who really knows how to get it done, but for the most part, when I've even made a match, I made a match with a unnamed pharmaceutical company and device company that I introduced to a device company in Khazaria, and they were really interested in it from the beginning. It took 2 years before they invested in the company and signed a distribution agreement because everybody had to get through. I did a deal in the ag space, ag bio, about 1.5 years, 2 years ago. Hardest deal I ever negotiated because we were dealing with a very large company that had to dot the I's and cross the T's all the time, and they would not even talk to us unless they had the same 7 people in the same room at the same time. So, and the only time they could accomplish that was on Sunday.
AgriBio, I think the last deal that were done in Israel, these are platform technology companies, early stage companies.
That was an early stage company.
Yes, I think with AgriBio,
yeah. Well, both of them that were done, the last 2 deals, one of which I did, and one of which I should have done, were early stage companies. That's a little bit, AgBio is different because you don't have phase 1, phase 2, phase 3. You can, you can develop. There are regulatory issues, but they're not the same kind of issues as you have with a pure biotech. You're trying to get a medicine, a drug approved. They're totally different. So, but yes, I think you are seeing really early stage deals getting done, but for the most part, the larger companies are looking for, and even some of the smaller ones. I met with a company here, a pharma company this week, that's looking for a certain type of technology, but their MO is to take later stage drugs and where certain things have already been proven where maybe the company is distressed and then try to build it up, and, take it and finish it, which is still not a one-day process or a 1 year or 2 year process. It still takes time. So, any other questions?
When you refer to later stage companies, do you refer to the end of phase 2, phase 3?
I think later stage, truthfully, is in the eye of the beholder, but the really late stage is phase 3. Most, I know there's one deal that I'm working on where the underwriter won't take the company out until they clear phase 2 totally and are ready to enter phase 3. There's another deal I just finished where, because of the impact of the drug, they were willing to take them out while they were in the middle of phase 2. So a lot depends. Now that's for the offering stage. That's for financing stage. If you're talking about an acquisition stage, then it really just depends on how much competition there is, what stage it's in, how important the drug is, which is really what's the market. What do they really view as the market? How many, or sometimes you have a drug that may add something to your existing drug that gets you another, 18 years, 16 years, depending on when you get, after you patent it, depending on when you get out. So, which Barry could probably speak to better than me. But so it really depends. I mean, late stage will never be phase 1 or preclinical, and it's never going to really be the beginning of phase 2, but it could be in phase 2. But and there are different kind of companies. There are the companies that develop their product with the intent that they're never going to commercialize it. They don't want to commercialize it. They want somebody, you can make a lot of money in a biotech company and still do good by advancing it from phase 1 to phase 2 and then selling it. And there are people that don't care if they do good, I'll be honest with you, that all they care about is advancing it from phase 1 to phase 2 and then selling it. And whatever happens, happens, as long as they make money. So, I've seen, and then there are people that all they care about is doing good. It just depends. But, so today, obviously there are different ways you can finance a company. The normal way is, one of the ways in Israel, not the normal way, is the Tel Aviv Stock Exchange, which is a good way to make money up to a point. I'm not going to knock the Tel Aviv Stock Exchange on camera here, but I have had people raise the issue that their valuation, the value of the company becomes much lower because the Israeli market does not really understand the life science market, and it is an issue. However, you can quickly raise money these days by filing a registration, which we don't do this, by the way. We don't do Tel Aviv Stock Exchange, but filing a registration statement or filing whatever offering document, tender offer document, and I've seen people do it in a week or less. So, we're not talking $50 million. You're talking $4 or $5 million, $7 million. But in Tel Aviv, you can raise money quickly. The downside, and you can get some liquidity. Some companies only do it when there's no other way to raise money, because they're concerned about what the value is. So if you have a company that, without being on the Tel Aviv Stock Exchange, maybe is worth $50 million, but it's trading at 20, you have strong concerns about going out there and raising money. And that does happen. I mean, again, valuation is subjective, but sometimes, even in the U.S., not just Tel Aviv, if you don't have enough trading in your stock, your market value can be low enough. No one's going to pay you more than what your stock price is, ever. So, unless they're buying the whole company at a premium. But to invest in the company, they're never going to pay you more than your stock price. So, and usually they're going to get a discount, especially if it's a private investment in a public company. So, going out on Tel Aviv Stock Exchange is a good thing, but you have to understand the risks when you do it. I'm not, and there are plenty of companies that have raised money to finance their business and have then done much better because they've done it, but there are some drawbacks. Doing the same thing in the
Biomed Index, the last year did more than the Tel Aviv 25 or 75, about 30%.
Yeah, it was unusual. It was, but I mean, but still, companies, even though they went up, a lot of companies will tell you, in fact, almost every company I talk to will tell me that trades primarily. Also, some of that is because some of the companies trade primarily on another exchange, and they're also trading on the Tel Aviv Stock Exchange. But almost every company I talk to would tell you that they think, first of all, they'll tell you that they think they're undervalued on the Tel Aviv Stock Exchange. Whether they are or not is a different issue, but
But yeah, the investor is money. So
yeah.
they
Yeah.
have some money.
Well, I mean, I know a number of companies that raised a lot of money on the exchange this year. They may not have been happy with their valuation, but they raised it. Some have done it 2 or 3 times.
What do you think it's the best to go public? What stock exchange?
I don't know that there's a better stock exchange.
Out of frame.
Okay. I'm a wandering Jew. What can I tell you? I'm sorry. I don't know that there's a better stock exchange. Really, right now, if you could do an offering on the New York Stock Exchange, MKT, which it used to be American Stock Exchange, or NASDAQ, or New York Stock Exchange, which is unlikely unless you've been out there, they're all good.
What about the AIM?
I'm not a big AIM fan, but, you know, but if you can, again, I see that as having similar problems. You can raise money, but then your liquidity is not so great. Your liquidity is not so great if you list on some of the other exchanges either, depending on how you get there, which I'm going to talk about in a minute. But most people will tell you that they want to be on NASDAQ. They'd love to be on New York Stock Exchange, but most people prefer NASDAQ in the U.S. to NYSE MKT. And actually, surprisingly enough, although NASDAQ has slightly higher qualification standards, it's a little bit easier to deal with, to get on. They seem to be more receptive to trying to get people on. So if you hit the standards, you don't run into as many issues. They're not as tough as interpreting some of their rules. Yes?
So in the long run, where do you see the biopharm in Israel? Are they all going to leave the existing the local stock exchange and go to America?
The Tel Aviv Stock Exchange? No, I don't see anybody leaving because it's really hard to do that.
No, I'm talking about new ones. Okay. So
Oh, it depends.
in the long run, are we going to lose the vast majority?
I hope not. I mean, I'm a big fan of having as much going on here as possible. I did the Prolor Opco deal, if any of you are familiar with it, and I've represented both companies, but I represented Prolor here with the waiver, and the CEO of Prolor and I were pushing for the company to list on the Tel Aviv Stock Exchange, which it did. That was a good thing for them because they qualified for the index. You know, what's the exact name of the index on the Tel Aviv Stock Exchange? But they were one of the 10 or 12 largest companies on the Tel Aviv Stock Exchange. Yeah, well, no, it's smaller than that. So they ended up with additional investors. But the company is now about 20% in Israel in terms of value. So maybe even a little more. So that made sense. I don't think you will lose the Tel Aviv Stock Exchange because there's always going to be a need. I just think somebody's, you know, and I have no idea what the issues have been. I mean, why the issues are there. I've never done that, but I think that there are obviously things that need to be worked on because, or maybe it needs to be more broadly available, but all I can tell you is what companies tell me, and there's a common complaint that their stock price has been low, which is, I agree, lately, just because the markets have all been so good, that it's probably not as much of an issue, but it's still an issue.
That's why I asked the question. You mentioned it.
No, I understand.
Prices are low over here, so why go public over here?
Because maybe you can't over there. Or you
So
can't.
that's-
Yeah. I mean, I used to be a guy who would tell everybody, don't go public. And I take companies public, so it's not good for me to tell people this. But although I do private deals too, but I would tell people, don't go public if you can raise the money another way right now until you're big enough. Because you have costs and headaches and liability issues and things like that. I don't necessarily do that as much anymore. I used to be strongly against certain types of financings. but I see them working, and I see people being able to do follow-on deals. So, you know, whereas before they didn't. You know, the main ways to go public, the number one kosher way to go public is you hire an underwriter, and you do a public offering, you file a registration statement, and you go public. And it's never a certainty until it's done. But, and that's a great, you know, way to do it, because you have somebody following you. Hopefully you have an analyst who's going to be following the company. You know, you should have some trading market. But, and a lot of companies are doing that now here that couldn't do it a year and a half ago. Not because they weren't worthy of doing it. They just, you know, the market wasn't there. So the number one thing when you're doing a deal like that is to hire a good team and to totally do is, you can't control a lot of things anytime you're trying to do a deal. But the one thing you control is how fast you work and whether you put yourself in a position to get it done. And you need to make sure you hire people that are going to take care of that for you. So, which means, unfortunately for some of us, that a lot of times we're up till 3 or 4 in the morning because you need to, or later, or you're, you know, calling the SEC on a regular basis and making sure that nothing slips through the cracks. You know, I mean, the timing, my last deal, the timing was, we're going to get the deal done this week, or we're not, because the underwriter's going on spring break with his kids. Okay, literally, that was the issue. And then we're going to have to wait another 10 days until they come back. They're not going to be here. Or Pesach is coming and you can't get an Israeli deal done. Or it's summertime, or it's Christmas break in the U.S. You know, in August it's very hard to get a deal done. In late December it's very hard to get a deal done. So, you know, and then you've got all the financial statement requirements, etc. That's the kosher way of going public. But other ways are becoming more kosher. I've seen a few companies, the smaller ones, do a private placement where they raise not necessarily that much money, as little as 4 and as high as 7 or 8 or 10, and then they register the shares that they sold. They're not registering anyone else's shares. They register the shares that they sold in the United States, which makes them obligated to report as a public company. There is absolutely, they're trading on over the counter. There's absolutely no trading market. Okay? But, and I totally counseled against this, doing this way, because it's, if you run out of money, what are you going to do? You're spending a lot of money to do this. And the transaction costs are much higher. Underwriter's going to do that, charging anywhere from 10 to 15% plus warrants. So if you use an investment bank to do it, it's not an underwriter because it's a placement agent. And, you know, the legal fees aren't really much less, if less at all, because generally speaking, those deals involve a lot of negotiation. You have a term sheet, you go out there, and then whoever becomes the lead investor starts negotiating it. And then maybe they don't, and this happened on the one I did recently, maybe that lead investor doesn't end up agreeing. So you end up looking for another investor for 2 months, and now you're negotiating a totally different deal. It's not a simple, easy process, but if you can get it done, sometimes it works. And there seems to be interest in follow-on deals from some of the smaller underwriters right now that you didn't used to have. So, which helps you then become more liquid, and helps you, get up to a higher exchange, whether it's NASDAQ or Amex, instead of just trading over the counter, the pink sheets or whatever. So that's one way. The other way is another way that people have done it historically is a reverse merger, which is it used to be you would find a shell, which is a public company that has no business. Maybe it used to have business, maybe it didn't. Make sure the shell is clean, and then the shell would form a subsidiary. If it was an Israeli company, it'd be an Israeli subsidiary. If the company we're acquiring that had a business was an Israeli company, it would usually be an Israeli subsidiary. The subsidiary would merge with the company we're acquiring that actually had a business. And now you have and all the shareholders in the Israeli company would get shares in the public company. They'd usually end up with somewhere around 90-some% of it. I've done a number of those deals, several, every company that Phil Frost started that became big, Key Pharmaceuticals, Ivex, and now OPCO, was started that way, as a shell company merger. Today, you would not look for a shell. Today, you would look for almost shell, because they've, the SEC has adopted new rules that make it more difficult for a shell company to trade on an exchange. It takes longer. There's a waiting period. Certain requirements you have to meet. Also, it's, it just results in long-term restrictions that are not fatal, but they become a hassle, a little bit of a hassle. That kind of deal, I used to also recommend against, unless you had somebody like a Phil Frost, because you have no liquidity of any significance, sometimes they have unique issues. But today, reverse mergers are being followed up with PIPEs, private placements in public companies, or secondary offerings. So you're not getting stuck with just at that stage. And as long as you don't do it with a total shell, you're usually working out pretty much okay. I did a deal, and because we're on film, I won't name the company, but years ago, there sometimes are unique issues in these deals. I did a deal, and because it was a shell company, a major investor invested in the company, and the stock price went up from 1 or 2 cents a share to $4 a share. Now, that was not actually what should have happened, because this investor never gave the shell credit for anything but the cash it had. But and then it merged with another company, and the CEO of the company was making no money because there was no business. The CEO of the shell company. So there was an article published that said, compared the CEO's compensation to the increase in the stock price, and it was ridiculously. There's no comparison, because he wasn't getting paid anything. The stock price went up from 2 cents to $4. So the SEC started calling and asking questions and stuff like that. We got past that, but it almost held up the deal for various reasons that they actually ended up doing, until we were able to get a letter from the SEC. But what time is it?
10 minutes.
10 minutes? Okay. So, any other questions right now? Barry, anything you want to add?
You said perfectly.
Okay, so I'm going to ask you a question.
Okay.
No, I mean, one of the other things that you see happening in deals today is the importance of IP. And valuation. So, valuation is a key issue on any private-public deal. And the biggest issue on valuation for this industry is almost always IP. That's one of the biggest issues, and I'll ask you about it in a second. I see a lot of mistakes in companies when they haven't really had a lawyer, or they haven't been careful on their corporate reorg. The other big issue I see is there's confusion as to who owns what. You don't document it properly. Somebody left, you were going to, they had an option, or they had shares, and they were supposed to give them back. You didn't take it back. You didn't issue shares to everybody. You didn't document what shares. Oh, you got 25%, I have 30%, etc. You would not believe how many times that turns out to be a problem. There was a deal I did with an investment by a company about 2 years ago, where I spent probably 50 hours representing the company, negotiating with the shareholders so they could, to get them all to sign a piece of paper that said how much they owned, because there was no proof. Literally no proof. It really happened. And they said, no, you promised me this, you promised me that. I mean, it went on for weeks. But on the IP side, Barry, maybe you can tell them your story today.
Yeah, so I'll tell my morning story, and this happens all the time. And we'll leave you with this one. And I'll talk at a very quick pace in New York, so we can do this in 30 seconds. Come here.
Oh, you have to be in the...
but I don't have to be here because you can hear me, right? Anyway, if I scream. Okay. So what happens all the time, and everyone in this room probably can relate, is you have a startup. The startup, like one of the first things they learned is you got to protect your IP. So they get a patent attorney and they file a provisional application, and then after they file a provisional application, within 1 year you have to file a non-provisional. This is, Israel, the whole world. Within a year you have to do it because you have to relate back. So you've got the 1 year time period. And then what everybody doesn't realize and the patent attorney doesn't drill in their head is, I always say we live in the 18-month world. Patent attorneys live in 18 months because after 18 months, patent applications publish. And so the biggest problem that startups have is they rush to get their provisional done because they're told that they have to do that, and then their provisional publishes after 18 months, and typically when you look at their non-provisional, which is published after 18 months, and then they're really on to generation 2. And the problem is generation 2, which is not covered in the first application, but would be, one argues, an obvious variation from it. So the best prior art is the own people's, what they just published. So the one takeaway I always have is, and there's going to be, I'll just give you the story of what happened here. The one takeaway is, don't, yes, rush for your provisional, but after like 15 months, take a look and say, sometimes you have to kill the provisional and say, we're not going to let this publish, or the non-provisional, and we're going to need generation 2. So it's this dichotomy that everybody teaches, go get provisionals, go get this. So that's one. So what happened this morning is I sat down with an inventor with a law firm from here, and they had told me their application actually was now 29 months. It had published, and they were going to go over the claims with me because I'm going to get it in the U.S. I'm going to prosecute this in the U.S., look at all this great stuff. So I look at the claims, and the person's going through it, the patent attorney, I'm going, that's great. And I said, okay, so now, inventor, show me what you're doing. So this is 29 months now. And he shows me what he's doing, and it's actually in the area of a diabetic test kit. And he shows me what he's doing, and I said, that's great, but you don't have the feature that she just told me she's going after. He said, well, we got rid of that. That's nothing to do with that. So it was the classic example, and I get this all the time, that the answer is they're into some new generation. They're about to spend a lot of money going what's called the 30th month, which you go into national stage, US, China, Russia, you get these astronomical costs, and basically they're going to scrap the application. So my 5 minutes, now they're going to decide that they really don't have this, but now we're going to have a problem because now we got this published application that's sort of similar to their new one, but not enough. So the takeaway I say to you is, don't rush into provisionals. Be careful, but evaluate that. And then the last thing I always say, this is Bob on the same side on the law side, is people view lawyers as, oh my God, I got to pay money for lawyers, and I have to do this because I'm going to do the deal, or I have to do this because I've got a patent. We're a partner of yours. If that person, if they would have called that patent attorney, I don't blame the patent attorney, and would have called the patent attorney just for 5 minutes saying, hey, we're looking at this new product, why don't you look at what we filed having anything to do with it, in 5 minutes they would have been done. But I think the world is all about collaboration. So for example, we always say, nobody would have thought that Facebook and Google would be fighting each other, because they're basically in the same space. If Google started off on Facebook, they were over here. Everything in this world, in the biotech world, there's a term we heard, which is really cool. There's nutraceuticals, there's pharmaceuticals, and now we heard this term called electroceuticals. And it's really, if you think about it, really cool, because the idea of treating people through electronic means, be it a stimulus or so forth, and you're going to hear this term a lot more, electroceuticals. The point is, everything is merging, and we're arguing that the law field should also be merging, and as a firm, but lots of lawyers are becoming business partners. I think it's more than it's ever been that a lawyer is not just a lawyer, they're part of the partnership. And like Bob was saying, when you're doing a deal or something, you should be calling early on and not, okay, I'm about to do this agreement, now what do you think? And that's the takeaway we want everybody to have. Everything in this world, everybody is merging. Everybody's got to be a team.
That was a long 30 seconds.
It was. Judges always say, Mr. Schindler, but you said 30 seconds. Yes, Your Honor, it was 30 seconds.
Yeah, so I mean, your lawyer is supposed to be a problem solver. And that's our job, to solve problems. Just if you can make it easier and have less problems, that's always a good thing. But, pardon?
For whom?
For you.
Yeah.
Cost,
for you.
No, I actually prefer, I'll tell you something, I've never had a client come back because I had it charged more. They won't, so it's sort of, it's great when you can do a deal for a company. I'm a corporate lawyer because I'm a lover, not a fighter. I don't believe in, I avoid litigation whenever I can for my clients. I just don't see it as a positive thing. No one ever comes out of it happy. So you're never happy with your lawyer because you had a lawsuit that you spent a lot of money on, and the result came out okay. You won. Maybe you didn't pay as much money, or you ended up, even if you didn't pay anything, you still had to pay the lawyer. So it's very unlike usual for that. But
we have a saying that says the best day of a patent is the day you sue on your patent. That's your best day. Then it's all downhill.
okay, so few more. I'll just give you a few little tidbits to finish up my 10 minutes. One of the things you should always keep in mind when you're working, and I don't know if we have any investment bankers in the room, but when you're working with an investment bank or a private placement, a placement agent or whatever, when I'm on a deal, I'm representing you if you're my client, and I'm not representing anyone else. The accountants, they're independent. They really are independent and to keep independent, they have this great rule that you have to pay them before they issue their opinion. It's a terrific idea. I wish we could get independence in our, but we don't. The investment bankers represent the company, but who are their customers? Who are their clients? Their clients are the people they're selling you to. So it's great, and they try and do, most of them try and do a good job both ways, but you have to keep in your mind that and understand that when you're dealing with someone who's raising money for you, while they want to make you happy, they have to make them happy. So if they don't make them happy, if they don't do well, then they're not going to be buying from them anymore. So it's more than just your deal. So, just keep that in the back of your mind when you're having conversations with them. I'm not saying anybody's not telling you the truth, but they do have that interest in their mind. And by the way, when you're doing a deal, there are a number of ways to look at what price you get. Obviously, you don't want to get diluted. You want to limit your dilution. But the other thing you don't want is you don't want somebody to invest in your company and then end up with a lousy deal. So, most of these people know how to protect themselves, and so you don't usually have to worry about protecting them. But in a public deal or things along that line, you don't want, you don't want to end up with something that turns out to be, an egg for the investor, because you end up with problems with that anyway. Any questions before I conclude? Okay.
Is there a difference